Hi, my name is Elliot Yu. I'm co-editor and publisher of Energy and Income Advisor, and that's an investment research service I co-founded a little over 10 years ago. Do you remember the drama surrounding oil markets back in early July of this year? I'm talking about when the mainstream media was fascinated by President Biden's trip to Saudi Arabia and whether he'd greet the Crown Prince with a handshake, a fist bump, or maybe just a disapproving scowl. Now in the end, Biden opted for the fist bump, which still annoyed many pundits who felt he should treat Crown Prince Mohammed bin Salman as a pariah for his alleged role in the murder of Washington Post reporter Jamal Khashoggi. To be fair, he did promise to do exactly that on the campaign trail. The consensus opinion seems to be the U.S. couldn't afford to alienate Saudi Arabia over the summer, with global oil prices so high and amid diplomatic efforts to more or less beg OPEC to produce more oil. Fast forward 3 months to just last week, and OPEC, led by the Saudis, agrees to a 2 million barrel a day cut to production, despite intense behind-the-scenes diplomatic efforts by the U.S. and other major Western powers. Now, the Biden administration issued a press release stating, quote, "The president is disappointed by the short-sighted decision by OPEC Plus to cut production quotas while the global economy is dealing with the continued negative impact of Vladimir Putin's invasion of Ukraine." The mainstream media now appears to have dubbed this a rebuke of the Biden administration. However, here's the real truth. The entire narrative surrounding the oil market in recent months is completely asinine, a complete and very dangerous lie. Handshake or no, Biden had absolutely zero chance of persuading the Saudis to boost oil production last summer. Diplomatic efforts to forestall the current production cuts were also doomed to failure. And Russia has little or nothing to do with the sky-high oil prices in the global economy, facing the global economy right now. More broadly, despite what you may have heard from some pundits and talking heads, the price of oil has nothing to do with diplomacy or politics. The situation is actually far, far more serious and dangerous than that. You see, here's the shocking point few in the mainstream media understand, and many politicians who are clued in would prefer you not to know. Saudi Arabia isn't cutting production because it wants to do so. It's cutting production because it has absolutely no choice. If you don't believe me, just look at the facts. In September, the Saudis pumped 10.97 million barrels of oil per day. And over the past 3 months, production has averaged 10.82 million barrels per day. That's a lot of oil. In fact, Saudi's average production of crude over the past 3 months is the largest in history. September production alone is the third highest monthly total for the kingdom in history. Of course, Saudi Arabia claims it can produce around 12 million barrels a day of crude oil, and it has authorized investments to expand that maximum capacity closer to 13 million barrels a day. However, no one can say for certain how long the Saudis can maintain production at that level longer term. What we do know is that the Saudis have only managed to produce more than 11 million barrels a day in short bursts. About 11.6 million barrels of oil a day in April 2020 and 11.07 million barrels a day in November 2018, the only 2 months in history where they've produced more than they did in September 2022. However, in each case, those production surges were followed by major cuts to production, down to 8.66 million barrels a day in May 2020 and 10.65 million barrels a day in December 2018. We also know, based on the geology of conventional oil fields, that producing an oil field too fast can harm the long-term productivity and resource recovery from that field. You only have to look at the Russian experience in the waning days of the Soviet Union in the late 1980s for an example of the dangers of producing too much oil too fast from a field like the USSR's Samatlor field. That's particularly the case for older fields and those where production is maintained through secondary techniques such as water flooding. Both conditions actually apply to the larger Saudi fields that were first put into production back in the 1940s and 1950s, and they've been using water floods on those fields for many years. So I'd posit that Saudi Arabia probably isn't trying to cut oil production to annoy or snub the US and Europe or show solidarity with Russia, as some have advanced. Rather, Saudi and some other major OPEC members are cutting oil output because they're already producing at or above their long-term, prudent, and sustainable level of production. Indeed, the new OPEC accord sets Saudi production at 10.478 million barrels a day. That's down a little over 525,000 barrels a day from the September total. However, that's still well above the 10-year average rate of production of about 9.8 to 9.9 million barrels a day. And if we look at the decade prior to 2015, when the Saudis started an effort to drive down prices after 2015 and squeeze shale producers, average production was actually closer to 9.1 million barrels a day. Now here's my hopefully educated guess. I suspect Saudi Arabia is perhaps capable of producing 11.5 to 12 million barrels a day for short bursts. They have, at least in 1 month in their history. They can probably sustain 10.5 to 11 million barrels a day for periods of a few months, as they have this year. But they're probably most comfortable producing at a rate of 10 to 10.5 million barrels a day or less. In that context, a cut in OPEC plus quotas and all-important Saudi output was inevitable, no matter how negative the reaction might be from Western oil consumers. Now that leaves the global oil market in a precarious situation. Brent oil currently trades at close to $100 a barrel. Despite near record OPEC output, as I just showed you this past summer, the fact that very few Russian barrels, if any, have actually been removed from the global oil market yet, and 1 to 1.5 million barrels a day of oil releases from the United States Strategic Petroleum Reserve just since last spring. The OPEC production surge is now wrapping up due to necessity, as I just outlined. The US has drained the Strategic Petroleum Reserve back to 1985 levels. These are unprecedented releases we're seeing from what's actually supposed to be an emergency oil reserve for the United States. And we can't continue with releases at that level much longer. And of course, Western efforts to cap Russian oil prices could prompt actual real declines this time in export volumes into early next year. In fact, the only reason oil prices aren't much higher right now is that global demand for oil, is softening a bit amid a global economic downturn. In short, this is a recipe for a new supercycle in energy prices, a bull cycle that could even dwarf that of the 2002 to 2008 era in magnitude and, most importantly, duration. You see, the only sustainable cure for higher oil prices is more supply. And increasing oil output requires years of capital spending and investment from private energy companies in new production projects. Massive investments in exploration and development on new fields are what finally ended the 1970s supercycle, bringing down oil prices through the 1980s. And it's also what ended the early 2000s energy supercycle as well. Unfortunately, there's little sign of new investment this time around. In fact, global spending on exploration and development for oil and gas stands at about half its 2013 and 2014 peak. And discoveries of new oil and gas reserves globally are near the lowest level in 7 decades. That's 70 years. Meanwhile, the US and EU seem determined to double down on failed energy policies, such as coercing OPEC to release a few extra barrels or attempting to accelerate a quote-unquote transition to intermittent alternative energy sources such as solar and wind. And look, I know you may have heard that renewable energy technologies and growing popularity of electric vehicles will break the global economic dependence on oil and other fossil fuels. However, the facts show that's a dangerous myth. The world consumed 94.4 quadrillion British thermal units of energy, known as quads for short, 10 years ago in 2012. And that's across all forms, including oil, natural gas, nuclear power, coal, and renewables. Of that total, in 2012, oil alone accounted for 37.25% of U.S. energy demand, natural gas for 27.7%, and coal for 18.4%. So if we take these three fossil fuels together, that made up a total of 83.35% of total U.S. energy demand in 2012, again, a decade ago. Now fast forward 10 years to this year, and the Energy Information Administration projects total U.S. energy consumption of 98.82 quadrillion BTUs, of which oil, natural gas, and coal account for 37.7%, 32%, and 10.6% respectively. So these three fossil fuels still account for 80.3% of total U.S. energy consumption. And oil and gas are actually more important this year than they were 10 years ago. For the record, non-hydroelectric renewables, like solar and wind, now account for just under 5.6% of U.S. energy consumption, up from just over 2% a decade ago. A modest rise despite a decade of rapid growth and significant government subsidies. Thus, the idea there will be a rapid transition away from oil, nat gas, and coal in the next few years that will render the global oil production industry obsolete represents a dangerous lie. Ironically, that lie, alongside government and investor response to it over the past few years, is all but guaranteed to blunt the market mechanisms that have historically offered an incentive for oil companies to boost supply that would solve the actual energy crisis we're facing. Let me be blunt. This inane global energy charade is terrible news for the US and global economies and for stock prices. Inflation will remain higher than expected for longer than expected, and recessions engineered by the Fed and other global central banks can only temporarily bring down costs. In short, it's the 1970s all over again, only even more dysfunctional. However, this is all great news for a host of energy stocks that will inevitably benefit from higher oil and natural gas prices, and a gradual upturn, eventually, in capital spending from the industry. So far this year, energy stocks in the S&P 500 are up about 54%, while the broader market is down more than 20% for outperformance of 75 percentage points, including dividends. My research confirms that much like the 1970s and the period from 1999 to 2009, that 10-year period, energy stocks are likely to be one of the very few sectors that can produce positive returns and sustainable dividend income that keeps pace with inflation over the next 5 to 10-year period at a minimum. If you'd like to learn more about how to benefit from the coming energy supercycle, I urge you to consider a risk-free trial subscription to my premium energy investing service, Energy and Income Advisor, that's available only through this website. I must warn you, like every other small business owner I've spoken to, my publishing firm is dealing with a sizable increase in costs due to the 4-decade surge in inflation. Everything from the cost of information services to the cost of hosting websites and credit card processing. Unfortunately, that means for the first time in a decade, I'm going to be forced to implement a hike in subscription prices and membership costs across the entire suite of services we publish, including our flagship Energy and Income Advisor. I should have already implemented this price hike, but my co-founder Roger Conrad and I have instructed our team to hold off on increasing prices just a little bit longer. If you click the button adjacent to this video presentation and accept my risk-free trial invitation to Energy and Income Advisor, we'll lock in the current pricing for the service. If you prefer to accept my risk-free trial membership offer to EIA by phone, you can call us toll-free on 1-877-302-0749. Tell our customer service manager, Sherry, that you watched this video, and you can call at any time between 9 a.m. and 5 p.m. Eastern Time, Monday to Friday. Whether or not you choose to take me up on this risk-free trial membership offer today, I urge you not to ignore the noise about oil and energy in the mainstream media, and look at the facts and data I've presented. Examine what's happening around you right now and take action to protect your portfolio. Investors in the 1970s learned the hard way how an energy price supercycle can keep inflation elevated, erode quality of life, particularly for investors who rely on their portfolios for dividend income. And it can result in more than a decade of negative inflation-adjusted returns from the S&P 500. That's not what I wish for you. There is another way. Again, if you'd like to accept my risk-free trial invitation to Energy and Income Advisor today, click the button adjacent to this video. I hope to greet many of you as new members to the service over just the next few minutes. Thank you for your time.